you'd be not doing your fiduciary duty as an investor to basically just decide to ignore the financial sector altogether because you're afraid of what's happened in the past. Because it really has turned a leaf. It is completely different. It's a totally compelling, different investment case.
Hello and welcome to the latest episode of the Algebris Investments Podcast. So, look, we're 2 months into the year and we felt it would be a good time to provide an update on things related to financials. So, I'm pleased to be joined by Bruno, Duarte and Benjie, Creelan and Sandford as members of the investment team with a focus on financials. As mentioned in the past, understanding and having coverage across the full capital stack when investing in financials is super important. Bruno is a fund manager for the Algebris Financial Credit Funds, and Benjie is an equity analyst focused on global ex-US financials. So Bruno, Benjie, thanks for joining. I'm going to start with a question for both of you, and I'll start with you, Bruno. Can you summarise what happened in financial credit and how things have started in 2025? We'll get the credit view and then we'll ask Benjie the same question.
No, absolutely. Financial credit last year was actually at a very interesting crossroads because we just come off a very tumultuous event in the previous year. And I think the market was still kind of at 6s and 7s trying to figure out where we would go from there. It was pretty obvious to us that there was a big demand for high quality cash income out there. And very few sectors actually offer that. So we're blessed that all we do pretty much within Algebris is looking at financials, which is a very fertile space for picking up those sort of credit and those assets. And whether you're looking at AT1s, there's still a lot of skepticism about whether they would be the asset class to own last year. But if we consider that Credit Suisse happened and we're talking about 7% of the AT1 space basically being written off to zero, we still had AT1s up something like 22% with volatility of 5. So to think that we're having sharp ratios in excess of 3 times for an asset class that de facto was all but finished that weekend in mid-March tells you a lot about this asset class in this space. So it's kind of continued into 25 so far, probably with a little bit more impetus to add and chase even further. I think what's happening is that the credit space is becoming more mainstream now. I think everyone has realized that it's really not as bad as people make it out to be. And all the muscle memory of the past, where everyone thinks that European banks are bust, they don't make any money, I don't want to waste my time with them. I think they're slowly coming around to it could actually be an interesting space to be invested in for 25 and most likely beyond that as well.
Okay, great. And then Benjie, what's the equity view?
Yeah, I mean, a lot of that applies to the equity as well. I mean, you look back at 2024. I mean, look, it was a very good year for global financials. Global financials universe was up over 25% over the year, but there was plenty of ups and downs within that. Lots of volatility, particularly around politics through the year, both in the US and in Europe. With what happened with the European and French elections, and equally rate volatility was very much front and center as well. You had the 100 basis point spread between the highs and lows of the US 10-year through 2024. But as I say, on the whole, the banks and the financials came through that very solidly. And the start of 2025 has been very fast indeed, particularly with regards to the European banks, which are already up 20% year to date. And I think that's because through a lot of last year, referencing those kind of top-down themes, a lot of the debate in the market remained the same around European banks, and it was basically around the sustainability of the earnings stream, as rates come down, what that would mean for net interest income, if the growth outlook slowed, what that would mean for asset quality. And the bank's been delivering consistently solid results and sort of outperforming the fears around those areas. And I think that track record is now starting to feed into an actual re-rating of the equity. And we've obviously talked about that plenty of times in the past. So a lot of the performance year to date so far has not been driven by earnings upgrades. There are still earnings upgrades, but a lot of it has been an actual re-rating. you've kind of gone from, in Europe, you've kind of gone from 7 times towards 8 times PE. But obviously that still leaves, ample runway for further re-rating, given the longer run average for the sector is above a 10 times PE.
Yeah, and I think, that's led to articles that we've seen saying, look, stop worrying about the Mag 7 and think about the Mag 47. But just on one of the points you just talked about, maybe stick with you for this. Did Q4 results play out as expected? Were there positive, negative surprises?
Yeah, I guess dare I say it, 4Q results were boring in the sense that it is very much consistent with what we've seen in prior quarters. So you had another quarter where the vast majority of names delivered beats to market expectations. I think on average it was high single digit profit beat in 4Q. And the themes within the results again remain very consistent with what we've seen over the past few quarters. So net interest income typically doing better than expected. So again, we're now seeing the evidence that even as rates come down, banks are managing that decline better than what the market has kind of been pricing in.
And this is actually really important, because it's one of the easy pushbacks that a lot of people have to be skeptical about the banks, to say, well, where rates are likely to go, net interest income is going to be affected negatively, so I'm not going to look at it. But this is a really important point for saying it's sustainable, and it doesn't mean that people shouldn't be looking at the banks.
No, exactly. And banks are not immune to the interest rate environment, right? It's still a very big lever. But what lots of banks have been doing as interest rates have gone up has been hedging their balance sheet so that they're not as sensitive to a decline in rates. And we're seeing evidence of that now coming through. But you're also seeing evidence that, interest rates isn't the only single driver of the P&L for the bank sector. So you are seeing, again, as rates coming down, you're seeing some nascent signs of recovery in volume growth, which is supporting overall NII levels. And there's other parts of the revenue base which are doing well. Fee income in particular has been very strong across a number of banks in 4Q results. So you've got the revenue picture doing better than expected, and we keep looking, and we remain very vigilant around this, but there are still no real meaningful signs of any substantial or meaningful deterioration in asset quality. There is obviously individual files and pockets of potential stress, but as I say, on the whole, an extremely benign picture on asset quality at the moment. That's keeping provision levels again typically lower than expected, and that's also supporting the overall profitability.
Great. Okay, and then Bruno, just come back to you. So, given what's been discussed so far, in general terms, what does this mean for outlook and positioning with regard to financial credit overall?
No, I think a lot of investors are actually faced with a bit of a dilemma, because right now the issue that everyone has is, we all know that spreads are very tight, they're very compressed, and actually very few spots actually offer this excess ability to over-earn
on a relative basis.
So I think we've always have to be mindful that whenever we're out there and we're looking at investors and what they're thinking about, it's never about really what you have, it's about what is available for them to look at. And I think where financials really stand out is the fact that, to Benjie's point, I think the SX7E has fourfolded from its lows. European bank equity earnings are up 75%. As a case in point, the US banks, if you take out JP Morgan, are probably down 25-30%. So it's a very big difference that Europe has really caught on.
Over what period?
The last 5 years. Right. So, if you consider that that's been the delta, you definitely want to be looking at European banks. All of a sudden, if the Mario Draghi plan takes off and if we decide to do something, the European banks will have to get their act together. So from a valuation perspective, from an earnings perspective, things are extremely different today than they've ever been. And so anyone that hasn't really been invested in the sector is now almost forced to have to look into the sector, because the multiple levels, as Benjie was saying, I think what's absolutely astounding me is that you have some situations where some share prices like UniCredit's have gone up by a magnitude of maybe 4 or 5x, but the earnings are only up by that amount as well. So there has been de facto no re-rating that has yet taken place. And I think this will be the next leg of the story. And to what Benjie was saying in terms of the earnings and what we do with it, what's I think quite interesting from the credit side. So obviously we're credit guys, we're the more boring guys, we're the more conservative, bearish guys, we're the half full cup guys. What we would say is that when you look at core capital levels, they haven't been really accruing that much. But the reason they haven't been accruing is because buybacks and dividends have just been off the charts. Even a bank like Montepaschi de Siena is now actually doing dividend buybacks and engaging in M&A, which 3, 4, 5 years ago would have been completely unheard of. And so that's how much this sector has changed.
From a fundamental perspective.
From a fundamental perspective. And I think you'd be not doing your fiduciary duty as an investor to basically just decide to ignore the financial sector altogether because you're afraid of what's happened in the past. Because it really has turned a leaf. It is completely different. It's a totally compelling, different investment case. And this is why, whenever we start engaging the debate with investors, you find more and more willing to take on the view and saying, you know what, you guys might be right. And, I think it makes sense to put some chips on the table.
And this is on an absolute basis, but also on a relative basis, particularly with a financial credit strategy relative to other areas of credit markets where people are looking for income.
Absolutely, because the one thing that people still believe is that the AT1 sector is kind of like a three-headed beast sector, and they want to avoid it. But more than half of AT1s are already investment grade rated.
Just explain the three-headed beast.
Well, basically what the rating agencies did when they decided to rate the sector over 10 years ago was they decided that because a normal bond does not stop its coupon, an AT1 can, a normal bond will always redeem, an AT1 can extend perpetually, and because a normal bond, you shouldn't really lose your principal, and yet an AT1 can equitize itself, it's almost as if they decided to notch one for every one of these three factors. And so they got very concerned about it. So what that means is you might have a differential of 3 to 4 notches between the senior rating of an entity and the actual rating of the security. But if you take a name like a BNP, where all AT1 coupons have always been paid, all bonds have ever been called, no principal has been extinguished, then you get this amazing rating arbitrage opportunity where senior might pay you 70, 80 bips, but AT1s will pay you 3, 4 times X that. And that's where if you get comfortable with this investment case in the European financial landscape, it just makes a lot more sense to come into the AT1s, take the more junior parts of the cap stack. And the reality is, to Benjie's point, if you are comfortable now with AT1s and you've rid them in after the past year or so of 20, 25%, maybe you should look at equity. Maybe you should go further down the capital structure. And I think that will be the next kind of segue into some investors who are looking at it because, AT1s, equities, they do go hand in hand. AT1s have done well. Equity's starting to do well, but I think it's going to continue.
Okay, great. Okay. And look, it would be remiss of me not to talk about the macroeconomic geopolitical environment and the impact that has on risk assets and the investing environment more generally. So it is acceptable that it's more volatile at the moment. It's likely to stay that way. How should investors incorporate that into their thinking when they're allocating to financial equity? And then I'll come to you, Bruno, as well.
Yeah, look, it's something you can't ignore. It's something that we're very, very focused on. And, as I say, European bank sector has started very fast this year. We're not kind of caught up in the euphoria and, ignoring the potential that there could be, some moving parts within that. And yeah, there's still a lot of uncertainty about tariffs and what that might mean for growth. There's still uncertainty about the exact direction of travel in terms of interest rates. Particularly in the US, and then how that feeds through into Europe. So, all these things you can't ignore, but you have to you go back to the starting point of the fundamentals of the sector, as we've been discussing, are completely transformed versus where they have been. So, again, when you're worrying about a potential slowdown in the economy, what that might mean for asset quality, you kind of go back to the fact that unemployment currently remains very low. You go back to the fact that there hasn't been really any huge amount of credit expansion coming into this cycle over the past 10 years in Europe. And as Bruno was saying, the capital strength of the banks and the general balance sheets is incredibly strong. So there is a huge amount of buffers there in any case to begin with. So I think, never be complacent. But the fundamental starting point is very strong. And then you go back to the point that we're only at the beginning of a kind of a re-rating process. These are not entities that are trading on peak multiples, far from it. Say the sector has kind of just about kept pace with the earnings upgrades it's seen in recent years. So it's more about being able to sustain those earnings. I think leaves still substantial scope for further re-rating.
And whilst investors are waiting for that re-rating, the dividends are high and better than many other sectors. Share buybacks are coming into play as well.
No, exactly. I mean, and yeah, I guess that was the other theme in 4Q results. Net interest income coming in better, provisions continuing to remain low and benign. But the other thing, the full year results was, just more delivery on capital return. So the sector is still offering around a double-digit yield. Majority of that's coming in cash, but there's a number of banks still doing buybacks. Some of those banks are still trading at sub-tangible book value, so the buybacks are still pretty powerful in terms of what that means for accretion going forward. So you've got the re-rating potential, but as you say, you're kind of still being paid to wait for that to come through.
Okay, great. And lastly, Bruno, just to you, the macroeconomic environment, geopolitics, how should investors think about that impacting their thoughts on investing in financial credit?
Look, I think it's a very multifaceted world out there. What we tend to do here is I think we start from the principle that the best hedge is to not have to rely on needing a hedge. And so what we do, and I think what Benjie alluded to, is just know your issuers. Just know your ins and outs of any sort of name that you buy. The added dimension to credit over equity is, whereas with equity you can only buy or sell the stock. I think with credit you have a lot of different ways of doing it. Whether you decide to go into AT1s, into Tier 2s, into seniors, even in the AT1 space, there are bonds and then there are bonds. You have different structural features that make some much better than others. So, we're definitely looking at ways in which you can probably protect yourself by ensuring you have probably the best type of instruments that people will want to be in and avoiding the ones that you probably don't want to be in.
There's no need to chase.
There is absolutely no need to chase, and it's something that we think it's very prudent to be mindful of what you have and what you decide to pick up, because we saw a very volatile period that we all knew was coming was in the second half of 21, where everyone knew that all the excess liquidity was going to lead to a massive surge in inflation. We knew interest rates were going to have to basically respond to that, and yet you had a plethora of AT1s that came in the second half of 21 with coupons in the 3 and the 4s. And those bonds were trading down 30, 40 points within the next 6-9 months. I'll never forget Bank of America issued a Tier 1 with a 4 3/8 coupon in January. And in April or May, it was issuing a senior bond with a coupon higher than the Tier 1. And so you got completely backwardated coupons across the different parts of the capital structure, which made no sense. So I think we have to be cognizant that the world can change very, very quickly. You have to be able to respond to that. And I think the only way you're on a good footing to ensure that nothing happens is to make sure you are fully aware of what's inside your portfolio and you're very happy with your stock selection. So that comes down to what we do. Equities, credit, AT1s, they sit side by side. Benjie, myself, we work, we discuss all sort of stories and themes that come through. And that just ensures that you're not sitting in a name that could get you into trouble. Because as you've probably heard me explain countless times, when you buy a bond, you have sold a put option. And you have to be very conscientious of that buying any bond, you are de facto short the stock. And that's the danger out there. And if you don't do your homework, you can get cut out very, very quickly.
No, I think that's the point, because in these kind of forums we tend to talk about European banks and the outlook, and whilst the outlook for European banks overall is, we're still very confident and think it's very strong, clearly individual names within that are going to perform very, very differently. And as we have mentioned before, particularly from an earnings point of view, the past 3 years being a great environment as rates have been going up. But certainly now that rates are peaking out, individual banks' balance sheets are going to be set up differently for how they react as rates come down. Different banks' business models are going to be better placed in terms of their ability to access growth, their ability to access alternative earnings drivers over and above just what the interest rate environment does. So the individual stock selection becomes ever more important going forward.
It's crucial, and as an active manager, that's a vital part of what we do. Yeah, okay. Well, look, that just leaves me to thank Bruno and Benjie for their time and thank our regular subscribers. Until next time.